In today's episode, I'll talk about three very interesting stories. In the first story of the day, we look at what is exactly happening with the Federal Reserve, or the Fed, which is the central bank of the United States. In the second story of the day, we'll analyze the quarterly results of JSW Steel as well as Tata Steel to understand a little deeper as to how the steel industry is shaping up in India. And in the third and final story of the day, I'll talk about how there's a new trend, so to speak, regarding exports in India. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 11th of November. In the first story, let's take a look at what is exactly happening with the Federal Reserve, or the Fed, which is the central bank of the United States of America. Look, the Fed plays a massive role in shaping the economy, and one of its main tools here is adjusting interest rates. Now, for your context, you can think of interest rates as the cost of borrowing money. Higher rates make it more expensive, which can slow down borrowing and spending. On the other hand, lower rates can make borrowing a little cheaper, which could encourage more spending and investment. Now, these rate changes directly impact inflation, job growth, and the overall economic stability. Now, very recently, Fed decided to cut its interest rates by 0.25, bringing it down to a target range of 4.5 to 4.75%. Now, this follows another cut back in September when they had reduced rates by 0.5%. Altogether, that is a 0.75% reduction in just the last few months. The question here is, what is exactly driving these cuts? Look, the Fed is focused on achieving a balanced economy, so to speak. They want to encourage growth while also keeping inflation under control. Currently speaking though, inflation is slowing down. It is down to 2.1%, which is a huge improvement from the 7% that we had seen 2 years ago. Now, this suggests that Fed's earlier rate hikes may have helped tame inflationary pressures. But at the same time, the US economy is still showing some signs of strength. The economy grew by about 2.8% in the third quarter, and consumer spending has also been pretty solid. Now, even with inflation cooling down, steady growth in spending shows that people are still confident in the economy. The job market is also another big factor over here. Over the past 3 months or so, job growth has slowed down a little bit. This means fewer new jobs are being created than they were being created before. Now, this slowdown is not really a natural change only. External factors like recent labor strikes and October hurricanes in the US have very heavily impacted specific sectors and regions here. But that said, unemployment rate is still very low by historical standards. It is sitting at 4.1%. While it's still slightly higher than last year, it indicates a stable market overall. Wage growth, which is how quickly people's pay is rising, has also now started to slow down a little bit. Now, this aligns with Fed's goal of keeping inflation around 2%. So essentially, the Fed is aiming here for a steady economy where wages and prices do not rise too fast or also too slowly. During a recent press conference, some reporters raised questions about whether the upcoming election might sort of influence the Fed's decisions. Fed's chair, Jerome Powell, was very quick to clarify, and he said the Fed's policy choices are independent of political events, inclusive of elections. He also emphasized that Fed bases its decisions on economic data and not really political speculation. And this independence, by the way, is very crucial for Fed's credibility. By staying out of politics, the Fed can also prioritize the economy's long-term health over any short-term political pressures. In fact, when Jerome Powell was asked if he would step down if President Trump or any other president requested it, he replied with a firm no. He also pointed out that legally, a president cannot dismiss the Fed's leadership, which helps ensure the Fed's autonomy. Now, even as the Fed is cutting interest rates, there is a very interesting trend in bond yields which have been rising lately. See, normally rate cuts make borrowing easier, which usually drives bond yields down. But here, bond yields are going up instead. You might think, what's going on? See, this necessarily is not a sign of rising inflation concerns. Powell suggested that markets may actually be betting on a stronger economic growth with fewer risks ahead. This signals that investors might expect the economy to remain robust even with lower interest rates, and they aren't quite worried about a major downturn over here. But even with these strong numbers, Powell has acknowledged that many people are still feeling the effects of high prices. He also explained that after a period of global inflation, it takes some time for prices to stabilize and for wage growth to catch up. And this is why the Fed is going for a gradual approach with rate adjustments rather than making large rate cuts all at once. Now, Powell also used a very interesting analogy to explain his approach. He used the example of landing a plane. See, as you get closer to the runway, you need to slow down and make careful adjustments rather than trying to land very quickly. The Fed plans to evaluate the economic data at each meeting and adjust rates gradually as needed in the exact same manner. Now, Pavel also shared insights from his discussions with business leaders across the country who seem optimistic about the coming year. Now, many of them believe that 2025 could be even stronger than 2024, which by the way has already been a good year economically. Now, the optimism here suggests that the economy has a solid footing for the near future. Now, one more point that is notable about inflation here is that while the overall inflation is down to 2.1%, the core inflation, which for your context excludes the more volatile categories like food and energy, remains slightly higher at 2.7%. Now, this gap is partly driven by housing costs, which tend to be a little sticky, which means they are slower to adjust. So, although inflation is moving in the right direction for sure, there is still room to bring core inflation closer to the Fed's target. The Fed's latest rate cuts highlight its ongoing balancing act, keeping inflation in check while also supporting economic growth. Now, at this point, I'm sure you might be wondering what exactly this means for India. Look, in theory, lower interest rates in the US are a positive sign for emerging markets like India because foreign investors will have to take higher risks to generate extra returns. So they may start to reallocate into emerging market debt, equities, etc., which tend to have higher yields. The other thing here is lower interest rates reduce the attractiveness of government bonds relative to equities. This means that if US equities start to rise, there will be sentiment effects on global equities as well. Now again, in theory, the Fed cutting rates might put some pressure on RBI to cut rates as well, but the RBI has been very clear that it does not care much about the US interest rates and it is more worried about keeping domestic inflation in control as well as ensuring domestic financial stability. But the thing is, in practice, interest rates are just one parameter and there are hundreds of things that move the markets. It's very important for all of us to not read too much into monetary policy. It matters for sure, but it is not the only thing that matters. Let's now move on to our second story of the day and talk about steel. Look, steel is everywhere around us. It is in the bridges we cross, the cars we drive, or even the appliances that we use in our houses. In many ways, you could call steel as the backbone of our economy. It holds things together and keeps everything running smoothly. And just as you might judge someone's health by their lifestyle, steel demand can tell us a lot about the health of an economy. When economies are growing, steel demand usually rises in order to keep up with infrastructure projects, manufacturing, and a lot more. But when economies slow down, steel demand typically takes a big hit. Now, globally speaking, China leads the way in steel production and they account for more than half of all the steel made worldwide. India, while it is smaller in comparison, is the second largest producer of steel, though China's dominance is crazy, over 50% of the steel. Now, India, to give you context, is smaller in comparison but is still the second largest producer. Now, while India's share is just 10% of steel, our role is expanding, especially as we are gearing up to meet both domestic as well as global demand. Now, within India, two big players, Tata Steel and JSW Steel, heavily dominate this industry. Now, both of these companies have recently released their quarterly earnings, and this gives us a very close look at how they are navigating the industry's ups as well as downs. But before getting into the specifics of their results, let's also consider the bigger picture of what is exactly happening in the global steel market. Look, with China as the largest steel producer, like I mentioned, they play a huge role in setting global prices. When China produces more steel than it needs, it exports all the surplus, which puts downward pressure on prices worldwide. Currently speaking, China's economy is struggling a fair bit. This means domestic demand for steel is much lower than normal. But rather than cutting back on production, China has kept up its output and they're exporting 100 million tons or even more of excess steel annually. Now, this surplus in global markets have been pushing prices down pretty heavily. So in response, several countries including the likes of the US and the European Union have imposed some tariffs and anti-dumping measures on Chinese steel imports in order to protect their domestic industries. India as well is looking to shield its local steelmakers from cheaper foreign competition, and they're considering tariffs of up to 30% of certain steel imports from China as well as Vietnam. Now the thing is, it is more than just a pricing issue. It is also about protecting local businesses from being undercut by these low-cost imports. Let me explain this using Tata Steel's example. See, in the recent quarter, Tata Steel reported a profit of 833 crore rupees, which is a considerable improvement from last year's loss of 6,196 crore rupees in the same period of time. But this turnaround largely comes down to a one-off factor. Last year's numbers were weighed down by impairment charges, which are write-offs that significantly impacted profits at that time but were not repeated in this quarter. But that said, Tata Steel still faced some challenges. Revenue from operations was down 3% year-on-year, totaling 53,905 crore rupees. The reason here was that they earned less on each ton of steel sold, especially in major markets where prices have been under a bit of pressure. Speaking about India, Tata Steel increased their production by about 5% to 5.27 million tons, supported by strong domestic demand. Yet, even with higher production, revenue from Indian operations declined for them by about 5%, and this was mainly due to lower prices as well as competition from cheaper imported steel. Now, in Europe, Tata Steel has a very different set of hurdles. In the Netherlands, they are contending with weaker demands and higher costs, which are driven by environmental regulations, and this impacts their profitability. In the UK, the company is shifting towards a greener form of steel production, which also involves some decisions like shutting down an old blast furnace. So while this move does align with some long-term sustainability goals, it adds a lot of significant costs in the short term for them. CEO Narendran acknowledged these difficulties as well, and he cited issues like inflation, slower economies, and the effect of cheap Chinese steel on the global markets. But that said, Tata Steel is pushing forward with some major investments in growth and sustainability. To give you an instance, Tata Steel recently expanded its Kalinganagar plant and boosted its capacity from 3 million tons per annum to 8 million tons per annum. Now, this brings Tata Steel's total production capacity in India to roughly 26.6 MTPA, which is a notable portion of India's overall steel capacity, which stands at around 160 million tons. Tata Steel is also now prioritizing some sustainability practices. They are setting up an electric arc furnace in the UK in order to reduce emissions, and they're backing this up by a £500 million government grant. In addition to this, they are focused on cost-cutting efforts, which is aimed at lower expenses by about £100 per ton by mid-2025, particularly in the UK where cost efficiency is very critical for their business. Moving on, now let's turn to JSW Steel, which is another major player in India's steel market. During the recent quarter, JSW Steel saw its revenue fall by about 11% year over year, and it reached about 40,000 crore rupees. Now, this drop was mainly due to lower steel prices and weaker export demand, which highlights just how much global market dynamics affect even the largest companies operating here. Now, their operating EBITDA, which is a measure of core profitability, was also down. It fell down from about 7,800 crore rupees in the quarter last year to 5,400 crore rupees in this quarter. But still, JSW Steel increased their production, turning out 6.77 million tons of crude steel, which is a 7% jump from the previous year. Within India, production hit a record 6.63 million tons. But that said, steel sales have actually decreased by about 3% from last year, mainly due to weaker export demand. Once again, the cause of this is the flood of Chinese steel in global markets, which has driven down prices pretty significantly. JSW Steel CEO Jayant Acharya attributed this decline in financial performance to temporary external factors. But there is a positive news on the horizon as well. The cost of coking coal, which is a key input in steel making, has dropped, which should help improve margins in the upcoming quarters. In terms of strategy, JSW Steel remains focused on growth and sustainability. They're targeting production of 50 million tons in India by FY 2031, and expansion projects are already underway in some of their plants. Like Tata Steel, they are also committed to reducing their carbon footprint, and they're aiming for carbon neutrality by 2050. A quarter of their operations are now also powered by renewable energy, which is a part of their larger vision for sustainable growth. So in summary, Tata Steel and JSW Steel both are navigating a pretty challenging global market right now. To deal with it, they're not only aiming at ramping up production, but are also investing in sustainability to future-proof their operations. Let's now move on to the third and the final story of the day. See, in the past year or so, a new trend has emerged among some of India's most well-known companies. As demand within India starts to slow down, particularly in rural areas, many brands are now turning their focus outside the country. They are finding success by exporting to overseas markets where demand remains pretty steady. Now, this shift is most noticeable in the automotive and fast-moving consumer goods or FMCG sectors, where companies are seeing more sales abroad than they might have hoped for domestically. I'm sure you're wondering why this is happening. Look, a combination of rising inflation, slower consumer demand, and cautious spending in India has made it very hard for companies to maintain their usual growth rates. Now, this is especially true in the rural parts of the country where multiple households are feeling the pinch of higher costs and are now becoming careful with their spending. Now, as a result of all of this, brands that were previously focusing mainly on the Indian market are now exploring international opportunities in order to keep their business growing. To put this into some perspective for you, let's look at some numbers. According to the Society of Indian Automobile Manufacturers, or SIAM, passenger vehicle exports from India grew by about 12% in the first half of the year, while domestic sales barely even moved and they only increased by about 0.5%. Now, thanks to these exports, overall vehicle production in India rose by 2.4% during the same time period, despite weak domestic demand. Now, to understand how this trend is exactly playing out, we also analyzed some data from 6 major Indian companies: Maruti Suzuki, Bajaj Auto, TVS Motor Company, Mahindra and Mahindra, Dabur, and Godrej Consumer Products. I'll quickly explain how each of these companies is shifting gears towards exports to power their growth. Let's start by talking about Maruti Suzuki. Now, of course, Maruti is a household name in India for affordable and compact cars, and historically, this company has relied on Indian consumers for most of its revenue. But in the past year or so, exports have grown to become a very essential part of Maruti's business. By the second quarter of FY 2025, exports started to make up about 14% of the company's total revenue. Maruti's main export markets include Africa and Latin America, where there is a rising demand for small and fuel-efficient cars, which is exactly the kind of vehicles that Maruti specializes in. In India, however, the demand for Maruti's entry-level cars have been very soft. Higher fuel prices and inflation have made it very hard for Indian households, especially in rural areas, to afford new vehicles. By focusing on regions like Africa and Latin America, Maruti is now positioned itself to grow internationally. The company is also expanding production capacity, which is a sign that it's serious about keeping its international demand. As one executive put it, and I quote, "Our expansion into high potential international markets is an opportunity to diversify revenue sources and mitigate domestic cyclicity." Then let's move on and look at Bajaj Auto. Now, Bajaj Auto, which is best known for its motorcycles and scooters, has now also shifted its focus outside India. Exports now make up about 40% of Bajaj's revenue, and it is driven by strong growth in Latin America and Southeast Asia. Over the past year or so, Bajaj has seen 9% quarterly increases in export sales as its motorbikes gain popularity abroad. In India though, Bajaj's motorcycle sales have been hit very hardly by rising fuel costs as well as inflation, which has hurt demand, especially in rural areas. In order to reduce dependence on the Indian market, Bajaj has now developed a comprehensive international strategy. This includes currency hedging, setting up local assemblies, and targeted marketing campaigns in high potential regions. Bajaj's presence in Brazil, for instance, not only minimizes currency risks but also allows them to connect directly with key Latin American markets. The company's management team also looks at exports as a very central figure to its growth strategy. In their words, and I quote, "We expect exports to continue bolstering the business." Then let's move on and look at TVS Motor Company. Now, this is another major player in the two-wheeler market, and it is also seeing some growth overseas. Exports now account for about 25% of the company's revenues, and export volumes have been rising between 10% and 13% each quarter ever since quarter 3 of FY 2024. Now, TVS's popular HLX series and their electric vehicles are particularly well received in markets across Africa, Latin America, and the Middle East. The Indian market though has not been as favorable for two-wheelers as the abroad market has been. Inflation has made these vehicles less affordable for many people, especially in rural India like I mentioned. In response to this, TVS is now building its presence abroad and even positioning India as a hub for producing premium motorcycles and EVs that are to be sold internationally. According to the company, and I quote, "Our focus on emerging regions aligns with our long-term vision to make India a center for sustainable export-driven growth." The fourth one we look at is Mahindra and Mahindra. Now, of course, Mahindra and Mahindra has also tapped into international markets in order to sustain their growth. Exports now make up about 20% of the company's revenues, with utility vehicles and tractors being especially very popular in Southeast Asia as well as in Latin America. Export volumes over here have consistently grown by 10 to 12% year on year across quarters, which shows a very strong demand for Mahindra's durable vehicles. But the domestic market here has been even more challenging. Higher input costs have affected Mahindra's vehicle sales, and a slower rural economy has hurt tractor demand in India. But by expanding internationally, Mahindra has been able to hedge against these fluctuations at home. As the company's CEO says, and I quote, "Diversification into exports offers a more balanced revenue and reduces exposure to domestic fluctuations." Let's then move on to the fifth company, which is Dabur, which has turned to exports to offset the slowing demand at home. By the second quarter of FY 2025, exports have accounted for about 20 to 25% of Dabur's revenue. The company's natural and health-focused product lines have found a very strong customer base in the Middle East, Africa, and Southeast Asian regions. And this aligns with global trends in health and wellness. Within India, for them, inflation has led to cautious spending, especially in rural areas, which has affected their sales. But internationally, their wellness products resonate really well, especially amongst consumers that are looking for natural alternatives. Dabur's CEO said, and I quote, "Our export goals are aligned with global wellness trends, enabling us to capture a large consumer base overseas." The sixth and the last one we look at here is Godrej Consumer Products. For them, exports now make up about 30 to 35% of the total revenue. Key markets like Indonesia and Latin America have particularly been successful for their company's growth, with export revenues rising by 12 to 16% every quarter for the past year. Godrej's domestic sales have faced challenges from inflation and intense competition. Essentials like personal care products have seen slower growth in India. But that said, the company's international strategy, which is focused on markets like Indonesia and Latin America, provides a stable foundation for growth. The CEO of the company said, and I quote, "Our export performance, especially in Southeast Asia and LATAM, provides a stable foundation as we faced increased domestic competition." Now, for these 6 companies, exports have evolved from a supplementary revenue stream to a key part of their growth strategy. By focusing on exports, they are now not only able to balance out the slower growth in domestic demand, but are also positioning themselves in the markets where demand is growing much faster. For Maruti Suzuki, Bajaj and TVS, it is all about bringing reliable, affordable vehicles to places like Latin America and Africa. For FMCG giants like Dabur and Godrej, the appeal is more on the lines of tapping into global demand for wellness and natural products. So as these companies are adjusting to the realities of slower demand markets in India, they are also setting a new trend, which is using exports to keep growing and insulate themselves from the ups and the downs of the Indian economy. Let's now move on to the final section of the day, which is the news tidbits. First, Policybazaar's insurance revenues increased by 41% in Q2 of FY 2025, while Paisabazaar faced challenges due to tighter RBI loan regulations. A potential 840 crore rupee investment in healthcare has also sparked investor interest amidst all of this stock volatility. Second, NGC and NTPC are set to acquire a majority stake in Ayana Renewable Power, which is valued at around $800 million US. This move aligns with India's renewable energy goals and could expand Ayana's capacity to 10 gigawatts by 2025. Third, India has now become the world's second largest smartphone market by volume. Smartphone sales have increased by 12% year on year, and the shift towards premium devices highlights India's growing consumer power in the global tech landscape. Fourth and the final one for the day, Jet Airways will be liquidated after a consortium failed to infuse the required funds. The Supreme Court's ruling underlines the importance of compliance with India's solvency regulations in the aviation sector. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.